Welcome guys to today's teachings. Okay, today we are going to be talking about internal range liquidity and market structure shifts. Okay, but before we get down to today's business, I've come to the notice that we are having currently over about 200 views on some of our videos, but the subscriptions is still very low. Okay, the subscriptions and subscribers are still very low, guys. So I want to plead with every one of us, especially those of us that are following us from Facebook. Okay, because most of our viewers are from Facebook. Okay, so I would actually like to plead with us to please subscribe to this channel. Okay, please subscribe to this channel. It's free, and promise you it's not going to take more than 5 seconds of your time to do so. Okay, it's actually free. Just take it as a way of showing appreciation for the efforts I am putting in creating these videos. Okay, so I really appreciate you subscribe to this channel. Don't forget to like the video and make sure to turn on the notification bell so that you get notified whenever we upload new content, which I always do almost every day of the week. Okay, I'm working on new contents on the ICT YouTube mentorships. Okay, so today we are going to talk about internal range liquidity and market structure shifts. So let's get down to the business of the day. Okay, so we are going to be looking at the Australian USD. Okay, remember we always start our analysis from the weekly time frame. Okay, we always look at the market from the weekly time frame to get our directional bias. Okay, so we use the weekly time frame to get our directional bias, just as we have talked about in our previous lessons. Okay, now this is not on a weekend. Okay, this is today's trading. This is today's price action on Tuesday, March 15, 2022. Okay, I took some trade today and I wanted to share with us regards to this topic of market structure shifts and internal range liquidity. So I use this concept, and this is actually episode 2 on the ICT 2022 mentorship. So and I applied it to today's trading, and I wanted to share with us how I got the entry. Okay, I actually got 2 entry on Aussie dollar on my money section trade. So that was all for the day. I was done for the day. I didn't hunt for any more entries because I actually got 2 in the money section. Okay, using the concept of market structure shifts and internal range liquidity. Okay, so I'm also going to talk about this in the futures market on today's price action. Okay, so but first and foremost, I'm going to look at the Australian US dollar, and I'm going to share the next video. I'm going to upload the proof on the trade I took today on the Aussie dollar. Okay, the live trade I took using this concept that I'm about to share with us today. Okay, so let's get right into this chart. Okay, let's do some annotations on this chart. Okay, now I want us to take a good look at this. Remember in our previous video we called that Australian Aussie dollar should be trading into this fair value gap, to this weekly fair value gap, and probably could reach for this old high that has buy side liquidity resting above it. Okay, now as we can see on the weekly time frame, price is just traded into the weekly fair value gap and is currently bouncing off from it. So it's like price is retracing off the fair value gap on the weekly time frame, but we are still very much bullish. Okay, price is still very much bullish in the sense that we are just retracing. This is just a retracement from the fair value gap. Price is still very much bullish. Okay, and where we are currently now, we are currently below the 50%. We have traded below the 50% level, which is into a discount market environment. Okay, we just traded off below the 50% level. Okay, this is actually a live chart. Time of making this video was kind of a live chart. The market was still very active. Okay, when I was countering the materials for these videos. Okay, so now we know our weekly time frame is currently bullish, but we are retracing, and we just traded off the from the discount market sector. Okay, so let's go down to our next time frame, the daily time frame, and see what we have. Okay, now notice this is that weekly fair value gap right here, and this is that old high. Okay, this is that old high. Notice we also have a weekly fair value gap above this old high. Okay, so this is one of the reasons I might be expecting some more bullishness on the Aussie dollar. Okay, so now you know what we use this time frame for. We actually use the daily time frame for liquidity. Okay, to know the drawn liquidity, and just like we learned earlier, price is being drawn to one of two things. Okay, to stops, buy stops or sell stops, or imbalance, to rebalance uh, price. Okay, so currently price is retracing off the weekly time frame fair value gap and giving the daily time frame a bearish bias. Okay, as we can see here right now, price has just traded off the weekly fair value gap and just broke structures. Okay, price just broke structure on the daily time frame, and we are kind of having a bearish bias on the daily time frame. Okay, so what we have right now is we have a weekly bullish trend, a bullish bias, and a bearish daily bias. Okay, so now price has just broken structure on the daily bias to the downside. Okay, now this is that weekly range. Okay, this is the weekly range here. Sorry, this is the weekly range here. Now looking at this daily time frame, where is liquidity, where is the draw on liquidity currently? What are we seeing now? Well, take a close look at this swing low. What is resting below this swing low is sell side liquidity. Okay, and price, as we know and as we have learned earlier, is attracted to one of two things: to imbalance or stops. In this case, we don't have any imbalance here, but we are having stops as sell side liquidity. We are having sell stops resting below this old swing low. So this might currently be what is attracting price, the daily bias, to be bearish. Okay, this might be what price is currently reaching for. Okay, but price might likely just trade off from, because currently we are below, we just traded off from below the 50% level, which is in the discount market. And whenever price is in the discount market, we look to buy because it's cheap, and when it's in the premium market, we look to sell because it is expensive at that very moment. Okay, so currently we have a bearish daily bias. Okay, and we have a bullish weekly bias. Okay, so now we might see price trade down to this swing low right here, taking out the sell side liquidity. Okay, you get what I mean. So price might just likely just reverse from here and keep on going up. So all we have to do is just to sit and watch price do its thing. So we can say that we are currently bearish on the daily time frame, okay, and price might likely reach for this old low, which is also below the 50% level, and we might see price take out this old low and get in sync with the weekly time frame. But we might never know, we can never tell. Price might just go up from here. So let's go down to our next time frame, which is the hourly time frame. Okay, now I want you to take a good close look at this. This is our Tuesday's opening. Okay, this is our Tuesday's opening. Today is Tuesday, March 15, 2022, and this is today's price action. Okay, now this is that weekly fair value gap that price has just traded off from. Okay, price reacted from here aggressively, gave a failure swing. This is a failure swing. Okay, price broke down, and this is that break of structure on the daily time frame. Okay, this is that break of structure on the daily time frame. So price broke down aggressively. Okay, price broke down aggressively, and this measuring this range. Okay, so all we have to do is to measure this range, because price just kept on expanding lower, expanding lower, expanding lower without a main without retracing. Okay, without a major form of retracement. So the price just kept on expanding lower until it broke down to the broke structure to the downside. Okay, so now we are seeing some kind of prior to today's opening, Tuesday's opening, price was just expanding downwards, and this is the overall equilibrium on the weekly range. Okay, while this is the daily range equilibrium. Okay, this is this from this trading range high to this trading range low. This is the equilibrium aspect of it. Okay, so if we are expecting a retracement which has not yet happened, okay, which has not yet happened, we are ignoring all this. We are it's just like we coming up to the charts for the very first time. None of this has happened. Okay, so we don't know for sure what is going on in the marketplace, but what we know is that we are currently below the equilibrium of the weekly range. Okay, the weekly range equilibrium, which is the overall going up, okay, which is this equilibrium here. We are currently below here, so I'm talking about this price action right here. Okay, that is what we are seeing here right now. Okay, so this is where we are at the market place right now. Okay, so now this taking our fib from this trading range high to this trading range low, once price created a kind of swing low, indicating price is about to retrace. Okay, once we take our fib out and we got this equilibrium. Okay, so now above this equilibrium, above the equilibrium, which is on the premium side, we have this little fair value gap. Okay, we have this little fair value gap. All right, so let's go down to our 15-minute chart and see what I mean. Okay, now this is that fair value gap above the daily range equilibrium. Okay, let's go back one more time, take a look. This, we are talking about this price leg here. This is that break of structure. Let's go up and see. Now we are talking about this range. Okay, we are talking about this range from here to here. We're talking about price breaking structure. Sorry, we are talking about price from here to here, breaking structure. Okay, taking it down. This is the price range we are talking about, from this high to this low. Okay, this is the equilibrium, and in a premium market we have this fair value gap right there. Okay, so none of this has happened yet. Okay, so now going down, so this is on Tuesday's opening. This is 12 o'clock a.m. New York time. Okay, now price currently trade down and created this short-term low in anticipation of a retracement. Okay, so now price has showed us that it's willing to retrace. Okay, now price is currently trading below the weekly equilibrium in a discount market. Okay, now what we have here is first swing low. This is the first swing low prior to 2 o'clock a.m. which is London session opening. Okay, that is what this tiny arrow is pointing at. This tiny arrow is pointing at the candle of on the that opened up the 2 o'clock a.m. London session. Okay, that opens on 2 o'clock a.m. London session. Okay, now this is the London session opening. Now we know that if we are anticipating, remember we talked about price, anticipation of price going higher, we should expect some level of stop stop hunt on sell side liquidity. Okay, which is what happened here. So what we do prior to London session, if we are anticipating higher prices, we look for the first significant swing low, which is this. Okay, we look for the first significant swing low, which is this is what we have here. We look for a run on the sell side liquidity, which is just what happened here. Price goes below an old low to grab liquidity after the London session opened. So prior to the London session opening, we look for a swing low, and we anticipate some level of runs on that sell side liquidity because we are anticipating higher prices, and which is what exactly happened right here. Price traded below this old low, taking out sell side liquidity. Okay, so I hope we are following, and I hope we are following closely. Now this is that swing low. Okay, this is that swing low prior to the the London session opening, which is 2 a.m. This is the opening candle that opened up the day. Okay, so now this is the 1 minute time frame. This is the 1 minute time frame. So when price traded below this old low, that is when we came down to the 1 minute time frame to look for a market structure shift. Okay, now in this scenario we are anticipating bullish movement. Okay, we are anticipating higher prices. Okay, now this brings us to our main topic for this lesson, which is market structure shift, or shift in market structure. Now what is a bullish shift in market structure? Market structure shift is when a short-term high is taken out, which is this is a short-term high taken out. If when a short-term high is taken out, and it is only significant if price has traded into sell stops, which is this. So now what this means that the market structure shift is only significant if price has taken out some level of buy stops, some level of sell stops in a bullish scenario. Okay, when we are anticipating higher prices, a market structure shift is only significant, it's only valid if price has taken out sell side liquidity, which is what we have seen. This is that old low on the 15 minutes. Okay, and price just took out, traded below it, taking out the sell side liquidity, resting below this old low. Now in other words, market structure shift is only anticipated when some level of sell stops has been taken out for a bullish market, for a bullish shift in market structure. So this right here is known as market structure shift. Okay, market structure, this right here is known as market structure shift, and it is only significant, it is only valid if some level of sell stops has been taken out, just like we see here right now, just like we saw here right now. Okay, so now price traded below an old low, taking out sell side liquidity, and this is a market structure shift. Once price took out this old short-term high, this is a market structure shift. Okay, this is known as a valid market structure shift. Now talking about order blocks, this is also an order block. Okay, but we'll come to that later. This is also another block, but we'll come to the term order block later. Okay, now this is a market structure shift, price traded upwards. Now for a bearish shift in market structure shift is when a short-term low is taken out. It is only significant if price has traded into buy stops. Okay, we don't have a bearish example here right now. We don't have a bearish example here right now, but taking a look at this, because we are So in a bearish shift in market structure, what we will be expecting is a reversal of this. Okay, so instead of a short term high be taken out, a short term low will be taken out after there has been a run on buy side liquidity, which is after an old high has been taken out. Okay, which is after an old high has been taken out. That is when we anticipate a market structure shift. That is when a market structure shift is only validated. Okay, so this is a valid market structure shift because an old low has been taken out. Price just traded inside under an old low, taking out the sell side liquidity. So that will be vice versa for a bearish when anticipating lower prices. Okay, a bearish market structure shift will be a price taking out an old high. Okay, trading above the buy side liquidity, taking out the buy side liquidity, and anticipating market structure. That is what that would be the only thing to validate that market structure shift. Okay, so I hope I've been able to explain, and this is what a market structure shift is all about. Okay, and how it is validated. Okay, so now let's go down further. So this is where we got our market structure shift. Price market structure shift right here, shifted here and traded up and started retracing downwards. Okay, started retracing. So we took out our fib. I took out my fib, measure it upwards, and yeah, there's a fair value gap. Okay, no, this one was covered. Okay, this one was covered. There's a fair value gap here, but I was only interested on this one right here because it's the one below the 50% level, which is in the discount market. So this is where I actually got in, and my stop loss was down here. Okay, so and I did this for my TP. You will actually see me trying to do this on the video. Okay, on the proof I'm going to upload after this video. I'm going to upload proof of this trade. Okay, I got two trades, two entries on the money session, and I was done for the day. So this is this was the first one. Okay, and I only recorded this, so I'm going to upload the proof of this, that I took this trade. Okay, so this was what I used for my entry, and for my TP, measured the range downwards, projected it upwards, and I got out right there. Okay, this is 100 about 168 pips. Okay, I got 168 pips here for my just for my money section first trade on Australian USD. Okay, now the next method you could have used to for your TP to get your TP is by taking out your fib and measuring your previous the previous trading range. Okay, this is the previous trading range. So we bought down here in discount at cheap price, and we'll be hoping to sell it at premium. And above premium, what is this? This is a fair value gap. This would have been here, would have gotten out. As me, I used the previous range to get my TP. Okay, this would have been my exit right here. Okay, remember, you're not trying to catch the whole daily range. Okay, you're not trying to get the whole daily range. Now this brings us to my second entry for the day. Okay, this brings us to my second. This is where I got my first entry. So this price came back, retraced, came back and broke structure to the upside, and this is known as engineered liquidity. Look at how these lows were engineered to be kind of respecting this trend line. Okay, so what is going to happen right here is that those guys that were that bought down here, as price trades away, they are going to bring their stop loss under here. Okay, they are going to be kind of sell side liquidity resting below, or sell stops resting below this old low right here. Okay, so now what is an internal range liquidity? An internal range liquidity is looking for short-term lows or highs inside a price leg that we are retracing back into. Okay, so now this is how I got my second entry from this range. Okay, from this range, when the market came back and retested almost this low here, and started expanding upwards, I saw this. Okay, I saw this kind of relatively equal lows, engineered liquidity, and I was like, okay. So price started retracing backwards. Okay, now using the concept of internal range liquidity, from this low right here, from this trading range low to this high, I took out my fib and I measured it out in time. Okay, so where is the short-term lows, in this inside this trading range? This are the short-term lows. Okay, this is a short-term low, this is a short-term low, this is a short-term low. So I know that what is resting below old lows is sell stops. Okay, so there is liquidity resting below this as an internal range liquidity. This is referred to as an internal range liquidity because it is inside, it is found in this trading range. Okay, this trading range is made up of this low to this high. So these short-term lows are found inside of this trading range. Okay, so this is referred to as an internal range liquidity, and here what is resting above here is referred to as external range liquidity. So this is external. From here, if you measure this range from this low to this high, this is an internal range liquidity compared in contrast to this range. Okay, and here will be an external range liquidity, and what is resting below here will be an external range liquidity. So also if you measure this range from this trading range low to this trading range high, this will also be an internal range liquidity and internal range liquidity. So also if you measure the range from this low to this high, this will be an external range liquidity and internal range liquidity, internal range. So an internal range liquidity is simply a low or a short-term low or a short-term high that has liquidity resting below it inside a trading range, as we can see here. So this was what brought my second entry. So I knew there was sell side liquidity resting below this old lows and is currently below the equilibrium, which is discount. So I was hoping that price is going to take out this short-term lows, and also there's a fair value gap right here. Okay, so now this is the definition of a fair value gap. I have not defined it the way ICT taught it. Okay, so fair value gap is a candle with a high. Okay, it's a candle with a high. So we have a candle with a high, one single pass up, sorry, a candle with a high right here, one single pass up, which is this candle, which is this particular one, and the next candle has a low that doesn't completely overlay, which is this particular one right here. So we have the candle with a high, and we have a candle, a one single pass up candle. Okay, and the next candle has a low that does not completely overlay the whole range. Okay, so leaving a gap behind. So this is a fair value gap. So this is where I got in on my second entry. So I got in exactly here, and my stop loss was below here. Okay, so I just looked at this old high as my TP because price we have to trade above this old high to expand higher. Okay, to create a higher high. So this was just what I targeted for. I target this high, this old high right here, and it gave me about 268 pips, which you will see. Okay, 218 pips, sorry. So as you can see, this was where I got in, and my stop loss was right here, and I targeted this old high. Okay, and I got out nicely with 218 pips. Okay, so that is all for that, and that brings us to the end of the class on internal range versus external range liquidity and market structure shifts. So I hope I'll be able to explain the concept clearly, and so I'm going to upload the proof of the first trade I took. Okay, I'm going to upload the proof, and you might want to check it out. So please, if you have not subscribed to this channel, please do so. I'm going to upload the next content is going to be on the same contest, market structure shifts and internal range liquidity, but it's going to be on the futures market, so you might want to watch out for it. Okay, so thanks for watching.